Good afternoon, everyone. Thank you very much for joining us today for a session as part of our Economy and Policy series. I am Shreya and I work with the Ananta Center. We run the Economy and Policy Initiative under our public policy vertical. And on behalf of the center, would like to thank Forbes Marshall for this generous support for this series. Today, we have some of the best minds in the country coming together, and I am truly delighted to welcome our eminent panelists. Dr. Montek Singh Ahluwalia, former Deputy Chairman, Planning Commission of India, Dr. Janmejay Sinha, Chairman, BCG India, Dr. Naushad Forbes, Co-Chairman, Forbes Marshall, and Chairman, Ananta Aspen Center. Thank you very much for taking out the time and joining us for this discussion. And we are delighted to have Mr. A.K. Bhattacharya, who is the Editorial Director of Business Standard and the Chair for the Economy and Policy Initiative at the Ananta Center with us today to moderate this session. Mr. Bhattacharya, as always, it is a pleasure to have you with us. We look forward to a very interesting and insightful conversation. With that, I now hand over to you, Mr. Bhattacharya.
Thank you, Shreya. Good afternoon, everyone. And thank you all for joining us today for this very special session under the Economy and Policy series. It's called the Mid-Year Indian Economic Review, Assessing Growth Prospects. This series, as you would know, is an initiative by the Ananta Center, which looks at examining the Indian economy and its growth potential. We will be soon completing 6 months of the current financial year. And at this point in time, the Indian economy is still recovering from the damages caused by the second wave of COVID-19 during April and May 2021. The session today aims at deliberating the current state of the Indian economy, identifying the possible recovery signs, and indicating the growth prospects in the second half of the financial year. I would like to welcome our 3 speakers for this afternoon. We have with us Mr. Montek Singh Ahluwalia, who is the former Deputy Chairman, Planning Commission of India. He has been a key figure in India's economic reforms since the mid-1980s, and is currently a distinguished fellow at the Center for Social and Economic Progress, New Delhi. Joining us next is Mr. Janmejay Sinha, who is the chairman of BCG India. He is a member of the Boston Consulting Group's Henderson Institute Innovation Sounding Board, which is dedicated to supporting, inspiring, and guiding upstream innovation at BCG. Welcome, Janmejay. Our third speaker is Dr. Naushad Forbes, who is the co-chairman of Forbes Marshall, India's leading steam engineering and control instrumentation firm. He's also the chairman of Ananta Aspen Center. Welcome, Naushad. What we plan to do in the next 1 hour is to get a sense of where the Indian economy stands at present, which is almost the midpoint of the current financial year. And using that perspective, we will try to project how the medium term and the long-term view of the Indian economy's growth trajectory looks like. To make this exercise a little easier, I intend to take a couple of minutes to present to you what the latest numbers on the Indian economy say, and then move on to our expert panelists and ask them some searching questions on how they view the future ahead. As you would know, the GDP growth for the first quarter of the current year is out. It showed a growth rate of over 20%. In spite of this growth, however, the size of the Indian economy was well below the level that prevailed in the corresponding period of the year before the pandemic, that is in April-June 2019. Agriculture has done quite well. Power, gas, water, and other utility services have also done well. In fact, these are the only 2 sectors which had obtained a real gross value added size in April-June 2021, which was higher than what prevailed 2 years ago in April-June 2019. All other sectors, including the critical manufacturing and construction sectors, were at a level lower than where they were 2 years ago. On the other hand, private consumption expenditure, which accounts for almost 55 to 60% of India's GDP size, the investment rate in the economy, and even the government consumption expenditure have all remained subdued. The GDP data for the second quarter will come in only about 2 months from now. But we can make a guess based on what the RBI has projected to be the annual real growth rate of the Indian economy in the whole of 2021-22. And if this growth rate is to then it would be safe to assume that the first half of the economy would still see a double-digit growth rate. But if this turns out to be true, which is the double-digit growth rate of around 17-18% in the first half of the current year, please remember that the growth rate in the second half of the current year would be in low single digits. Of course, I would be happy to go wrong in this if, as the government projects, the growth rate indeed turns out to be around 11% or more. But the short point here is that the growth trajectory in the second half of the current year does not look very good. Inflation, based on the consumer price index, is hovering at around 5%, a little above that. It is staying closer to the upper limit of the tolerance band of the Reserve Bank of India's inflation targeting regime. But nobody seems to be worried about inflation at present, and growth is a bigger concern. Unemployment, after hitting a high of 12%, according to the CMI data, in May, has been declining. In August, it was 8%, and in September, so far, it has stayed below 7.5%. Worryingly, the rural-urban divide in unemployment has got worse. The urban unemployment rate now is about 9%, compared to 6.8% in rural India. This seems to suggest that the 20% workforce, which are mainly unorganized, urban, and non-agricultural, are still very much stressed. Exports are a bright spot. They are consistently doing better than even the pre-pandemic months. India's cumulative merchandise exports stood at $164 billion in the first 5 months of the current financial year. This is the highest level of exports since the 5 months of 2017-18. Foreign exchange reserves are at a record high, and the current account balance, after being in the surplus last year, is expected to be in the deficit of just about 1% of GDP. In brief, this is what the Indian economy looks like as it enters the second half of the current financial year. Having set this background, let me turn to my panelists. But before I do that, let me request all participants to please send in their questions throughout the session and not wait until the end. We will be taking up your questions during the Q&A session. And if you are watching this session on Zoom, please use the Q&A portal at the bottom of your screen. And if you are on Facebook, please write your questions in the comments section. So my first question, which is the same for each of our panelists today, and that question is, what do you see as the key positives and difficult challenges for the Indian economy going forward? I would request that if you can give me 2 positives and 2 negatives, and that would be wonderful. Can I start with Monte?
Thanks, Ashok. Thank you for a masterly summary of this very complex mess of data. I mean, looking ahead is always a problem. I'm always reminded of the comments made by Yogi Berra, America's famous baseball player, also a part-time philosopher, who said it is very difficult to make predictions, especially about the future. So, you've put us in a position that Yogi Berra would not actually approve of. Let me respond to your questions. Positives, I think the main positive is that the economy has actually bottomed out. And as far as the formal sector is concerned, it looks as if for the sector as a whole, it may be getting back to pre-pandemic levels by the end of this year. It'll be different for different sectors because I think service sectors, etc., particularly the formal service sectors, will not recover that fast. But certainly by the end of this year, we will have got back 2 years of lost growth. Now, whether you call this a V-shaped recovery or an L-shaped or a U-shaped, that's not very interesting. But we are back to 2019-20. However, a big qualification here is that this is true of the formal sector. I don't think the informal sector is going to be back to where it was in 2019-20. We don't actually have enough information on the informal sector. One can assume, though, that if the formal sector now rebounds forward, the informal sector will also follow. So that's one aspect. The second you already mentioned is the size of the foreign exchange reserves. I think it's an important positive, especially at a point where the Federal Reserve is now beginning to signal a return to normalcy in its monetary policy. The last time in 2013, when you had a similar signal given, we had the temper tantrum and we had lots of problems. And we were able to manage those in 2013 without going to the IMF or anything. But I think this time around, the size of the foreign exchange reserves, which is $640 billion, makes one believe that, even if there's a temporary sort of problem, we will be able to ride it through. So that's the positive side. Negative side really is relating to where are we going to go after we get back to the pandemic level. I mean, I had no doubt that we would get back, whether we got back in 12 months or 18 months or 24 months was open. But certainly in 24 months, we will be back. Question is, what is going to be India's post-pandemic growth rate? Are we going to go back to the high growth that we had in the years from maybe 2004 to say 2016, 17? Or are we just going to go back to the pre-pandemic, which was a bit of a tepid growth rate between 4 and 5%? It's a very important issue. And to my mind, the most important determinant about whether we will have a healthy rebound is what happens to private investment. I mean, it is the collapse of private investment that has actually led to this big decline. I don't see that we have a clear game plan. And I think there's a problem here in the sense that the private sector is going through its own restructuring, its own deleveraging. This is good for the longer term because it will put it in a position where those companies that really want to move ahead will be able to finance an expansion. But right now, I don't see, it's not just a question of resources. There may be enough resources. I don't see the private sector beginning to plan its investment. And then the question is, will the public investment program be stepped up to step in? I don't believe that buoyant consumption is the solution. We need to bring investment back. And you could make a case that when investment slows down in the private sector, we need to jack it up in the public sector in infrastructure investment. When I say infrastructure, I include in that health and so on. So that's a big question for the next budget. Are we going to be in a position to be able to do that or no? And I think that's, when I say it's a question mark, I view it as kind of a negative. The second negative, which is relevant for our longer term growth strategy, is the great uncertainty that has now arisen on what is the strategy we are going to follow on trade policy and the open economy. I mean, the essence of the 91 reforms was to reverse the historical tendency toward protectionism. I think we did quite well in that process. and all the feeling that this would lead to balance of payments, deficits, etc., too many imports, all this was wrong. But what one hears now, the way Atmanirbhar is being interpreted, seems to be focused very much on reducing imports rather than just strengthening the economy. Because I think I saw a statement that, if we could get rid of imported wood being used in agarbattis, that would strengthen Atmanirbhar. Now, I don't think it will strengthen Atmanirbhar one way or the other. I mean, if you really want a strategic development of domestic capacity, that's an important objective, but it should not be translated into trying to cut imports wherever you can find them. And I'm not certain what we plan. I mean, there's a lot of concern that, in the last 3 or 4 years, we have refused to join RCEP, which we were negotiating for 7 long years. Our official policy does not say that we should close up. In fact, the Prime Minister himself has often said that Make in India means Make in India for exports. It means integrating with global supply chains. But if that is what we want to do, then I don't think this increase in customs duties and anti-import attitude will achieve that objective. And I think we need some clarity in that so that people can be quite clear what the future is going to be. Now, there are lots of other positives and negatives, but you said 2, so I've limited it to 2. Thank you.
Thank you. I think the negatives that you pointed out are very, very important, and I think it will raise more questions as we go forward. Let me turn to Janmejay and ask you to list out, if you don't mind, I will impose that limit of 2 positives and 2 negatives. Thank you.
So, if I was to build on what Mr. Ahluwalia was saying, I would say that corporate deleveraging has been very positive in my perspective, because we had a lot of companies which were really teetering, and the ability to have actually deleveraged makes their balance sheet stronger. And if you really look over the COVID period, their EBITDAs have really strengthened. So they have done things on the cost side, which may have hurt labor, but still, you would have to say that revenues have held up and the profitability has improved and deleveraging has happened. The second thing which I find quite interesting is the changing nature of money coming into India. And the tenor of this money seems to be longer. Because when we look at private equity and sovereign wealth funds and the amounts that they are bringing in, and also some of these companies, they have longer term horizons than some of the institutional money that was coming in earlier. And now with Evergrande even more, I think that, if you had $100, I mean, 50 would go to the China, and now I feel that may moderate a bit, and the 8 or 9 that used to come to India might become 12 or 13. So if there is a judicious use of this capital, it could actually be better capital than we were getting in the past. The 2 negatives in my mind, which are important right now, and when we discuss COVID and others, there will be some that I will want to highlight, which miss economic discourse, so to speak, but are particularly important. The first is that capacity utilization is low and the capital investment cycle has not begun. Okay, this is a real issue. I mean, this is a serious issue, that despite the fact that companies have strong balance sheets, the intent to invest is not clear. And if this is not there, then how do we actually deal with the momentum going forward? The second is, while I'm very happy with the discussions on privatization, on the NMP, I mean on the new monetization plan, etc., we will have to go beyond announcements on this. It is really critical that we see some level of disinvestment, some level of these asset movements, and we all know all the issues around them. Okay, so and we can go into them, but I think it's very important to see some real movement that starts to come in and start to send a signal around efficiency. It was exactly, I'm exactly with Mr. Ahluwalia on tariffs, but I think if, things like privatization begin, then, it will send a positive signal, and there is more to be done in that space.
Just to sort of get it clear, you talked about the changing nature of money coming to India. The new kinds of money that are coming to India will turn out to be a positive?
Yes, because I think that their tenor is long. They would not have, when you see money coming in from the SoftBank and others, they are taking 5-7 year bets. They are not moving in the same nature of some of the institutional investors who panic much more sharply than some of these people who are taking bets.
Okay, thank you. Now let me turn to Naushad now to list his positives and negatives.
Sure. So thanks, Ashok. But I'm also going to start by where Montek, I think, left off in terms of talking about the longer term positives for the economy and not the short term, because we'll talk, I think, about the short term. I think there's no doubt that end of this year we'll be back where we were in March 2020. But that means 2 lost years for the economy, which is not something we can afford. But we'll be back there. So we'll grow probably 9% this year to get back there. But I'd like to talk about the longer term.
Sure.
The 2 positives for the longer term, I think the first is the fundamentals of our economy. A young population, real consumption. When people buy apartments, they're not buying second apartments, they're buying apartments that they go live in. They're buying not second cars, but first cars that they use. And because of this real consumption, the moment people were able to, you see a recovery in consumption. It's less, I think, subject to sentiment. It's less subject to discretion. It's more a reflection of people wanting to live a better life. So I think there's consumption that is very real. And this is a strength, and it's a strength that I think will sustain us and can sustain us as an economy for 30 years. It's a long-term engine for us going forward. It's what's driven us forward over the last 30 years. It's got another 30 years to run, handled right. The second strength, it seems to me, is the flexibility of the economy. And the flexibility of the economy is, it was really brought home to me last year. If you look at CMI employment data, in April last year, 1 month into the lockdowns, unemployment goes from something like 6% in March to, if I remember correctly, 24 or 25% in April. So you see this huge increase in unemployment in 1 month. And then in the next 2 months, you see unemployment go from 24, 25% back down to about 8% by June. So you see this huge recovery in employment. And this, to me, is a reflection of 2 things. It's a reflection of the fact that we do not have safety nets, but it's also a reflection that because we don't have safety nets, people have no choice, and they will go out and work. There were all these forecasts of doom that people are now returning to villages, people will not come back to cities, etc., etc. And much of that, I think, many of those fears were actually not based on what happened. What we saw happen was that as soon as people could move back, they came back. As soon as people could get their jobs back, they did. So I think that flexibility, driven, by the way, by not having a safety net, is a great strength actually for us in the economy. And it's a reflection of a relatively small government. It's a reflection of a very flexible economy overall. The two negatives, well, the first negative is exactly the second strength that I talked about, which is that precisely because we have this very flexible economy, it comes from having an informal sector that is not protected, an informal sector that is very vulnerable, and exactly as Montague pointed out, an informal sector that is struggling today. It's the downward leg of the K or whatever. But until such time as we see a recovery in the informal sector, in the smaller services, small shops, rickshaw drivers, all of that, if you look at auto finance companies, auto finance companies are reporting their highest NPAs for lending to people who buy three-wheelers, because they simply went to NPAs that are as high as 40%. And it's simply because they lost their livelihood last year. And I think until we see substantive recovery in informal employment, we're not going to see a sustained ongoing recovery and get back to the kind of growth engine that we had for 30 years of new people coming into the consuming class, which can drive the economy forward. The second is actually social investment in schooling and skilling. We've struggled we're not in a good position as an economy in terms of our school outcomes. We were not in a good position even going into the pandemic. And these 18 months, I think, have seen serious backsliding from an already low position. And I really worry about that. I do not think it's receiving adequate attention in public discourse. And to me, it's the single longest hanging, damaging factor in our prospects as a country. If we cannot get our schooling right, if we cannot skill people, and we're giving up on the idea of inclusive growth because we will simply not have equipped our population with the essential skills that they need to participate in the modern economy.
Thank you, Naushad, for outlining your list of the positives and the negatives. I think you ended up where probably we need to enter into one big issue without which we cannot possibly have a discussion on the state of the Indian economy, which is the impact of COVID-19, to which Janmajay also referred to. I mean, maybe I think I should change the sequence. Let me turn to Janmajay and ask him that what do you think went right and what do you think went wrong in the way we managed the adverse impact of COVID-19 on the economy? I think I've already pointed out various areas where we ignored. But I think what would be your your understanding of where did we as a society, where did we as the government went wrong in managing, or went right in managing the adverse impact of COVID-19 on the economy?
So, I think when you have cataclysmic events, then attitudes change. You had women come into the workforce after World War II. You had Alibaba take off after SARS. And the COVID has been for so long that there have been some material changes in attitude which are going to exist. How we dealt with COVID, the fact is there is no playbook for a pandemic, without global cooperation at that stage, coming together, with an economic lockdown, which is like a self-imposed coma being brought about. And a lot of people would have argued, who knows whether correctly or incorrectly, that closing down and locking down like we did for a country as poor as India was not necessarily the best way to go. And if you see the second wave, which was much sharper than the first wave, the economic impact of the second wave was much more muted than the economic impact of the first wave, where we lost 24% in one quarter. So but I feel a bit sympathetic about how do you deal with a situation which you have not encountered before. But I feel that in dealing with COVID, exactly what Naushad was saying, that, loss of schooling for 2 years is the biggest hope and the biggest need for us going forward. There has been too much discussion in economics about labor and capital, and frankly, not enough about productivity. And the fact is that the new forms of, Sanjeev Mehta of Unilever will say, if you get 2 trials, it's a great deal. For getting 19 months of trial is enormous, so once you get that long a trial, you can actually change your education delivery. You can actually change your healthcare delivery. You can actually change the ways of working. The current problem that has happened is that the people at the top have not suffered at all, actually. And the people at the bottom who can't work on Zoom and with tablets, they have been hurt very hard. And so how do we actually start equipping them to prevent and to take advantage of what is now possible, and to not allow them to get trapped in a digital apartheid, which basically perpetuates their poverty forever. And that's a huge, important, immediate challenge which cannot be deferred. We talk about PLI schemes, which I totally don't support, and I look at these, which are really important elements where we need to accelerate.
Yeah, thank you, Dhananjay. Let me turn to Montek and pick up on what you said about what kind of growth rate that we will like to see post-pandemic. And you also hinted at the possibility and the dangers of how the informal sector of the economy may not have been in the pink of its health, just as maybe the formal sector may have done better. And Naushad talked about a kind of a K-shaped recovery. So one question is, what kind of a post-pandemic growth rate that is probably can be targeted, can be achieved? And if you want to achieve those targets, what do you think you need to do? And connected with that, what do we need to do to prevent a K-shaped recovery, damaging the strengths of economy and society as well? Okay.
It's for one take.
Me?
Yeah, that's for you.
Okay, fools rush in with angels fear to tread, and I guess I'm the fool. I think I'm very clear about one thing. We should set clear targets. And so far, we've been setting targets that we keep missing. And even today, we haven't seen a revision of the target. Are we shooting for an 11.3% growth of GDP or not?
Yeah.
Reserve Bank says it'll only be 9 point something. It could actually be even less. If we go back to where we were in 2019-20, let's say at the end of the year, then the growth rate will only be about 8%. So I think one of the problems we have to ask ourselves in the current year, if the revenue realization was predicted on the growth rate of 11.3%, obviously, if the growth rate is actually 8%, you're not going to reach those revenue levels. There's a lot of comment at the moment, quite good, I think, that revenues are doing better than they were earlier, but they're not doing as well as they were projected to do in the budget. So from that perspective, it looks as if revenues will be down. As far as the states are concerned, it's likely to be even worse.
Yeah.
So the real question is that if you believe that the current economy is on an 11.3% growth target, then you don't have very much to worry about. But if you think that maybe, it's only 8%, so there's a lot of unutilized capacity, you have to ask yourself that since revenues are going to be less, are you going to offset that by producing more expenditure? What kind of expenditure? That in turn means busting the 6.8% fiscal deficit target. Now, I'm very clear that if you did such an exercise and you busted the 6.8% target, I don't think I would be criticizing the government. And nor, I think, would anyone else. People would want to know, what's your game plan for tomorrow? And I think this obsessive focus that we don't want to bust this year's budget deficit doesn't make sense. What about next year? In my view, the next year's budget, to be realistic, I mean, we should be aiming, ideally, to go above 7%. And maybe if you're kind of making allowance that you can't do it straight away in one stroke, maybe have in your mind that you may go somewhere 6.5 or so. But if we just end up between 4 and 5, that's a real significant poor performance. And somebody should have the courage to get up and say so. I mean, if it's 4 and 5%, we don't want someone saying we are back to pre-pandemic. That, in my view, is a failure. So let's be very clear that we are calibrating the budget to do that. Now, what can we do? I think that in my view, if in the current year, we maintain the growth momentum, which might well mean having a somewhat higher fiscal deficit target than we have set in the budget, then what you need to do for the next year, most importantly, is to get the banking system in better shape than it is. And we are at the present moment discussing reforms. And I mean, one good thing is that everybody agrees with the general slogan of what reforms are important. I mean, we're all in favor of banking sector reforms. We're all in favor of GST being reformed. Well, if you define Atmanirbharta as strengthening the economy and increasing its capacity to export, we're all in favor of that. But the specific policies that follow from each of these is not adequately understood. I mean, take banking. I don't regard the merger of a big bank with a good bank with a poor bank as a reform at all. This is the first thing. What would be a reform, in my view, is something that introduces a structural change. And I've said this on many occasions, that if the government wants to signal an intention of structural change, by the way, the decision to privatize 2 banks is a good decision. I mean, let's see if they get it done. But 2 banks is a small thing. We can't be waiting 2 bank by 2 bank for the next 10 years. The structural change, which I think would make a huge difference, is if the law was amended so that the RBI got the same power of supervision over public sector banks that it does over private sector banks. To my mind, failure to do that is essentially telling the bank managements, don't bother about the RBI. We're the ones giving you the jobs, listen to us. That is not what a reform in the banking system is. Frankly, you've seen what has happened. We've had problems in private sector banks, but the Reserve Bank has been very swift in acting. I mean, the slightest suspicion, out goes the CEO. That creates an atmosphere in which bank managements also think that it's not just their shareholders. The RBI has to be felt to be responsible. In the case of public sector banks, that's simply not true, because the RBI doesn't have that power. And what's more, I think it's fundamentally wrong that you have one person from the RBI on the board of each public sector bank, and also one person from the finance ministry. Now, frankly, this allows managements to say, don't blame the public sector banks for anything, because we're all in it together, which is true. Now, if that wasn't the case, I think the finance ministry would be much more watchful that what does the market say is happening. RBI would be much more watchful, and the RBI would also take action. So I would simply say that, you can set up bank recruitment boards and interview people and this and that and the other. But as long as the government is still nominating appointing the persons concerned, you're not getting independence. So I think that this would be, in my view, a major reform separate from privatization. And by all means, let's push the privatization. but separate from privatization, this would make a huge difference. I'm in favor of the monetization initiative, which is actually just a continuation of the national infrastructure pipeline. I mean, the national infrastructure pipeline was a sort of a menu. The monetization after a couple of years answers the question, where's the money coming from? And I have no hesitation in saying that if it's properly done, it would be a good thing. But, you know, rather than focus on the 400 things that have been listed by Niti Aayog, which looks breathtaking and is a good start, it would be much better to say, look, we're going to do 5 of these, and this is how we're going to do it. Have a completely transparent way of discussing what are the terms on which the monetization would take place, allow people to comment, and make sure that the worries about handing over assets to cronies, except when they bid strongly, is put at rest. So I think if 1 or 2 of these things, and of course taking care of the very negative vibes that have been generated on trade policy, I think we would create an atmosphere at the start of the next financial year where people would begin to say that, you know, maybe the Indian economy is really on the move. That would be my view.
Okay. Two supplementaries, Montek, very good points. Now, one is that you wanted the fiscal deficit to be busted. Now, where do you think it should be busted? How should it be busted? And where should you spend?
No, by the way, I don't want the fiscal deficit busted. I want the government expenditure plan to be maintained. And if as a result of that, the fiscal deficit is busted, I don't care.
So where do you think,
So
where do you think the money should be spent?
Oh, I'm very clear on that. I mean, I think as long as the recovery hasn't gained strength, providing enough money to Magnarega is a very good thing to do.
Mm-hmm.
Clearing existing bills is a very good thing to do. You know, in our system, I mean, every joint secretary who runs the system knows that you can keep expenditure down by just questioning some bills. So that particular year, the expenditure doesn't take place. But in a period where the contractors have got their own budgets tightly squeezed, I think we should speed up these, or at least speed, where there's a question, disburse 80% of the funds and keep 20% back, so that, you know, you manage to lubricate the system. And I would certainly say that, you know, in the infrastructure pipeline, whatever can be done within the next 6 to 18 months to increase public expenditure would be good. I mean, the railways are a very good example. You know, we need to get that done because the whole climate change battle depends heavily on successful electrification of the railways. And quite frankly, it's not easy to do this on the spur of the moment, but it should be easy now to ensure that there'll be much more expenditure next year. Enough time to mobilize resources and so on to get the expenditure done. And then as and when the private investment picks up, you can scale back the public expenditure to a more reasonable level. I mean, I also feel, by the way, that reform of the GST, it's been talked about now for 3 years. Mm-hmm. And the huge excitement happens whenever there's a GST council meeting. And of course, states have different views. But, you know, the fundamental point is we have lowered GST rates far too much. The average rate in the GST is lower than it was meant to be, and we haven't reduced the number of rates. Now, how much more time does it need to make a substantive forward movement? Now, maybe we've lost a few months, there was COVID, etc. But, you know, if before the next budget, you could show substantial progress on this front, I think the government's credibility to those looking to see, are we serious about reforms, would increase. I say that because these are not reforms that are controversial. I mean, government itself wants them. All sensible people want them. There will be opposition. I mean, after all, we are running a democracy. So let's be clear, it's the job of the opposition to oppose. The opposition is not very numerous, so there's no harm in letting them oppose. But explain to the public the logic of what we're doing.
Absolutely. I think your suggestion on the banking system, the structural change that you talked about in the banking space makes great sense, except that perhaps we are all aware that one RBI governor lost his job after making that kind of a suggestion. But let me turn to Naushad.
No, by the way, nobody made that suggestion. With the greatest,
Well, I think I think the suggestion was made to the government by a former RBI governor, and that was shot down.
I'm not aware. I'm not
sure.
aware that many RBI governors have said many things, but I'm not actually aware that an RBI governor said that you should amend the law and extend the RBI's power over public sector banks to the same level.
There's a public speech by Urjit Patel wherein he demanded that this should be done, and the government just turned it down.
It was a lament rather than a demand. Ashok, it was a lament.
Well, the governor made that point, and you don't expect the governor. Anyway, that's a matter of debate. But I think
it's good. I compliment Urjit if he made that statement. And I can believe he would make that statement.
Yeah.
So making a speech is not the same thing.
Maybe you're right. But, even in an Indian, anyway, that's a different matter. But let me turn to Naushad. You talked about the K-shaped recovery. So what, from your perspective, what do you think needs to be done to change that pattern of growth that is happening for the better?
Sure. So I'm going to pick up on what Montek said, but very quickly on the Urjit comment. He made that statement, I think, in the context of saying that the NPAs in public sector banks were around 9%, and the NPAs in private sector banks were around 2.5%. And he says, based on that, he says, he made the argument that you mentioned, Ashok, I think. So so on the K-shaped recovery, I think it's been mentioned by Montek, and I'm just going to very quickly say, I think there are three things that we should do. First, government should pay its bills, the point that Montek made. And this paying your bills has the huge advantage of not only putting liquidity into the economy in a way that is very direct and immediate, but it has the additional advantage, and that even though it shows in spending today, it will show in less spending tomorrow because you've paid your bills. So instead of just deferring the amount, it's a wonderful way of actually stimulating the economy in a very immediate way where it doesn't come back to bite you next year. We saw some of that happen at the end of last year when the government paid its dues to the FCI, to the Food Corporation of India. Making payments for years of dues of the food subsidy, but that's to the Food Corporation of India. Here you can do something that's much more widespread and something that is spread through the economy in a multiplier way. Second would be social sector investment, which we spoke about earlier on. Really investing in public health systems through the states and in education, again through the states. Now, this is a very good thing to do, but it requires then a new cooperation between union government and states in doing the right things together. And how do you structurally set that up? What mechanism do you set up to really improve public health systems? If you can't improve public health systems and invest substantially in public health systems during a once-in-century pandemic, when are we ever going to do it? Because this is the time that everyone would agree and accept that it makes a great deal of sense, and it's something that can be done coherently, union and states. And third is, again, a point that Montek made about infrastructure investments. And I think, when economists have looked at, that if you were going to spend 100,000 crores, what would you spend it on to stimulate the economy as effectively as possible? I think the worst thing that you can do is to cut GST rates, because that's very expensive and leads to very little improvement in demand. The best thing that you can do is to invest in infrastructure, because you're creating assets. And if you can invest in infrastructure that puts a lot of people to work, such as, for example, in good road building programs, you can then actually stimulate demand reasonably directly by increasing employment and incomes in a more multiplier way.
Thank
So
you.
those would be my three things.
Thank you. Thank you. I think all of them are very relevant. Let me turn to Janmajay, and you mentioned about the PLI scheme, and you had serious reservations about it. And if you look at the government statements, PLI schemes are actually at the centerpiece of the government's growth revival strategy, so to say, investment revival strategy, so to say. What are the specific reservations that you have in mind for PLI? And is it beyond repair? I mean, can it be salvaged, or it has simply have to be abandoned? What are your views?
Philosophically, I don't believe the government has the ability ever to pick winners. It is just difficult. So whenever we start creating, incentives for a particular sector, there are three issues that I have with schemes like PLI. Vested interest capture is very easy in democracies. You just look at the multitude of subsidies we have, which can never go away. And it's not easy, and they don't go away. We can do direct benefit transfer, but we can never get rid of the subsidies, which are actually in every way hurting us. Fertilizer subsidy, it is a continuous pain. Now, to believe that you will create a PLI scheme, it is forever. Whichever scheme you are creating, it will take hundreds of years for it to ever be unwound. And the ability to pick that this is a scheme that will get done and then it will take off, I think is fraught with problems. I mean, I would look at this issue, between 2000 and 2010, China went from $1 trillion economy to a $6.5 trillion economy. India did very well. It went from 480 billion to 1.7 trillion. So it was the second best performer. But the truth is, the US helped China get there. Now, it is for once with COVID, it is very clear that we really need to create a technology partnership of the kind that can actually generate long-term growth of a different kind. We will keep talking about jobless growth, etc., if we don't start addressing this issue. Even as we talk, as economists, we all get trapped into infrastructure. And even though we want to say soft infrastructure, we end up talking about hard infrastructure. And it is very hard to fix soft infrastructure. It doesn't have immediate results. Now, the fact is that how do we think about the world in the future, in the geopolitics in the future, will have cooperation, will have accentuated competition, and will have very sharp conflict. Sharp conflict will be in technology. And we need to be able to understand that agreement on standards, whether it is privacy rules, data localization, monopoly definitions, immigration, cyber rules, the whole gamut of them is going to be very difficult with some countries and easier with others. We will need to pitch in there and then decide what we need at the high end and what we need at the low end, so that everyone gets a mini pad for life, which they can access education, health, some of their schemes, some government actions. And at the high end, we start investing more in some of these universities where just now they're just 500,000 engineers who can do artificial intelligence in the world, of which we have about 25,000. We need to get that number to 2.5 lakhs, very quickly. And this is, the problem is the immediate tends to completely demolish the important. And this important was yesterday's important. It's not even today's important. And we will struggle with it tomorrow and day after, So I don't know how we can actually emphasize that in a manner which becomes palpable and real, because then we can start moving that real agenda of a GDP which is starting to show total factor productivity improvements and getting sustainably increased.
Okay, thank you. Point well taken. Let me turn to Monte. Everybody acknowledges that, everybody meaning most people, agricultural reforms that happened in 2020, the new 4 labor codes, and the promise of rationalizing the GST. They are all steps in the right direction, now, but then there are problems that everybody sees that their implementation has seen. Now, as somebody who has tracked the Indian economy so closely for so many decades, what would be your recommendations to make sure that the agricultural law reforms, the labor codes, as well as the GST rationalization issues, these things get sorted out and resolved in quick time, so that the gains in terms of economic growth can be realized without any further delay? Monte.
Well, thank you, Ashok. Let me just briefly respond. On the question of the agricultural laws, I have consistently been of the view that the modernization of agricultural marketing arrangements is desirable, and it's in the interest of farmers. I think the problem is that, in my view, that the way this was handled created a huge amount of doubt and suspicion. Now, there have been lots of political discussions on why they were not discussed adequately. It has been said that these were discussed earlier, and that's true, but the earlier discussions were always in the framework where these things were deemed to be in the domain of the state government. So I remember when I was in the Planning Commission, we were already urging state governments to do these reforms, but the idea was we were urging them to do it. The difference now is that the government, having obtained legal advice, and I'm not competent to pronounce on whether that legal advice was valid or not, has come to the conclusion that constitutionally, the central government can make these changes. But all the more, if these are changes that for several years have been thought, even by the government, to be in the domain of the states, and you're making them directly, I think a much greater process of discussion was necessary. The problem is when that doesn't happen, politics takes over. And now, it's impossible because farmers are convinced that the whole thing is a plot to close mandis down, to reduce MSPs, to get rid of, which the government has never said. But quite frankly, this has to be taken at the political level. It cannot be, as economists, we have really nothing to contribute. But I do agree that the farmers need to be persuaded that the modernization of marketing should be possible without the fear that farmers will become at the beck and call of a few capitalists. You may call them crony capitalists or whatever. And I think you should also be reassured that the mandi system, for those who prefer it, will actually continue. Now, what you do with the MSP is something that you decide every year. And there'll be a separate argument that people will say MSP should be high, MSP should be low. That is left to the Committee on Costs and Prices to work out. I think on agriculture, that's my view. On labor, I think a lot of very good work has been done. I don't know, it hasn't been notified. It has been passed, but the rules have not been notified. Maybe there is some resistance. I have only one problem. Economists were, when it comes to getting rid of multiple definitions, and are absolutely correct, we should do that. It's ridiculous that we have different definitions for the same thing. I think the sensitive issue really relates to whether employment contracts can be terminated under certain terms without the permission of the government. Now, what these laws have done is that the earlier provision was that for anybody employing up to 100 workers, the Industrial Dispute Resolution Act did not apply. That has now been raised to 300. This is not a big reform because it was 300 in 1982 when Indira Gandhi lowered it to 100, okay? Personally, the flexibility that you need applies not just to fellows in the 300 grade. It should apply to fellows in hiring 5,000 workers. But you need to build into that a certain amount of protection, a certain amount of some kind of social welfare benefit, some kind of layoff period, whatever. So I think that has not really been addressed at all. And what is the danger in raising 100 to 300 is that all the other elements of the law cease to apply, including safety, etc. I see no reason why the safety requirements and so on need to be relaxed if the enterprise is hiring more than 100 people. I mean, 100 people is quite a lot. I mean, if the safety requirements are sensible, I mean, they may not be sensible, but that's a different matter. There's no reason why you should relax those. So that's my view on the labor side. On the GST, I've already, I mean, there's complete consensus that this needs to be done. Even the finance ministry has said this needs to be done. Now, frankly, we have a GST council. If you decide that you're going to wait until you get consensus, then you're giving every state a veto. And that, to my mind, would be disastrous. We do have a weighted voting system. They should take the matter to a weighted voting system and fix it. I mean, there are certain things the center could do which would increase, confidence in the center's intentions. And one of them is to get rid of all these surcharges, etc., which are not subjected to sharing. I mean, one of the biggest complaints of the state. This has nothing to do with the GST, because they can do that independent of the GST. But that is the issue that the states are talking about. Now, quite frankly, I don't see any justification whatsoever for the center to be imposing non-shareable surcharges.
That's right.
I think that should just be got rid of. And I have no doubt that sooner or later it will be got rid of. If it has to be got rid of in phases, let's announce that we are doing it in phases. Something that will let the states feel that, look, the center has done something which all states have been wanting. And I think that would really create a different atmosphere for the GST Council to move forward.
Wonderful. Thank you. I hope the government is listening to these eminently sensible suggestions that has been made here. Let me turn to Naushad, and we are coming to the end of this excellent session, which is that the advent of green energy, and it is truly very disruptive, and probably is also a much needed change in the economy, in the mobility sector. What are the things that we should be mindful and watchful about, because they will cause some disruption, and for both policymakers as well as industry, we should be careful while introducing this green energy and electrical vehicles, everything, all those things. These are very important issues, and yet they should not cause disruption in a manner that growth is affected. Your take on that?
So, we should do, again, three things. The first thing that people should do is they should read Montek and Utkarsh Patel's paper that they've just written for CSEP on getting to net zero. It's really a very good paper, which is it combines an understanding of scenarios and where we're going with reasonable and I think doable approaches. To me, the second thing that we should do is to try to reduce uncertainty as much as we can, because when we're dealing with an issue like climate change and dealing with a huge transition, like going from fossil fuel-based vehicles to electricity, say, based vehicles, that kind of transition is a massive transition involving thousands of firms, millions of people who are employed in the industries concerned. The best thing that we can do is to try to make it as certain a process as possible. One of the big opportunities to reduce uncertainty is to have alignment within government. So, for example, when we talk about mobility and electric mobility, right? What we've heard is one year from Niti Aayog, another year from the Transport Ministry, and another year from the Industry Department. And in the end, which is it actually going to be? So is there a clear view of by when do we expect to see this transition to electric mobility actually taking place? Because then firms can plan, investments can take place, and people know what they can look forward to and in what time frame. The third thing is that if you want to foster any industry like this, what do you actually do? The best thing you can do, and it comes back to a point that Janmay made earlier on, is invest in talent. And how do you invest in the right kind of talent and build the right kind of talent as quickly as possible? We have this huge opportunity in the country because we produce 1 million engineers a year, 1 million plus engineers a year. That's a huge opportunity to actually create talent that will be powerful in the future. So how do you create that talent? By having the government do its public research in the higher education system, fund research in the higher education system in those fields which matter for the future. So fund research in solar, fund research in electric mobility, fund research in batteries, fund research in other forms of energy storage, fund research in hydrogen and hydrogen economy. These are big opportunities that we have to actually create talent that can be quite not only quite competitive, but can be ahead of where everyone else is in the world, simply because of this huge supply of 1 million engineers who we produce each year. The last thing that I think we can do is try to get whoever we can to participate in the economy. That the government is doing, right? Try to get the Panasonics of the world to set up battery factories in India, and try to get companies that are in the auto space to set up electric vehicle manufacturing in India, but set up some of the core technologies that could be very powerful. But I think we need to address the talent question much more directly.
Yeah. Thank you, Naushad. We have come to the end of this discussion. There are two questions that I must raise, which has come from the audience. One question is, does the reduction of fuel price can be an answer to stimulating the economy? And let me also come up with the second question. Has the interest rate regime bottomed out? These are the two questions. If either Montek or Naushad or Janmay would like to address them.
Can I take the fuel price one very quickly?
Sure.
I think fuel prices should be higher, right?
Okay.
Not lower. The best thing, if we want to bring about this kind of transition away to a carbon neutral economy, the best way of doing so is to have higher fuel prices. It's the way of actually fostering the right kind of movement across the economy. And I don't think fuel costs are so large a part of any either industry or consumption baskets such that it makes a huge difference to the average well-being of either the company or the individual. So I think actually bringing about an increase in fuel costs through the right use of taxes, even if the prices don't increase naturally, I think would be the right way to go. So I would argue for the opposite of the question.
Okay, that's an interesting response. Yeah, I agree with you there. I think sort of we had a 1 hour, 10 minutes of discussion on the prospects of the economy and the challenges before the economy. The takeaway for me is that the strengths that all our panelists highlighted, pointed out, look to me are very solid features of the Indian economy, which are often ignored. And if you compare the challenges and the risks of the negatives of the economy, actually you can take the risk of being a little optimist about the future of the economy. That's a message I get, and I think all our panelists have indicated a way forward. So the problems that we face are not something that are insurmountable, cannot be resolved. So that optimistic note, I will hand back the floor to Shreya. Shreya?
Thank you very much, sir. And I'd like to thank all our speakers and all the audience that has logged in for this discussion. It was an absolute delight and pleasure. Thank you very much.
Thank you.
Thank
Bye.
you. Thank you. Thank you.
Bye.
Bye-bye.
Bye. Bye. Bye.